They don't panic. They don't get greedy. They don't even sleep. But can machines really outsmart human investors? Or are we just outsourcing risk to something we barely understand? AI agents and AI trading to automate investing. It sounds like a news headline from the future, but it is already happening. A world where algorithms run portfolios, read the news, and trade billions in milliseconds. AI takes over Wall Street. One truth is becoming clear. The machines are fast, but not always right. In 2024, the global AI and finance market hit $38 billion, with projections crossing $190 billion by 2030. AI isn't some experiment anymore. It already drives more than 60% of US stock trading volume. Firms like BlackRock, Goldman Sachs, and Citadel use AI agents to scan billions of data points, everything from interest rate statements to Reddit threads, all in real time. And it works. In 90s, at Renaissance Technologies, mathematician Jim Simons built one of the most successful hedge funds ever, powered by quantitative algorithms, the early ancestors of today's AI agents. The fund averaged 66% annual returns before fees for 2 decades. AI turned patterns into profit long before most people knew it existed. Cathie Wood once said, "AI is the software revolution that will redefine every industry, including finance." And she's right. But as every revolution shows, scale doesn't come without cost. All AI agents aren't investors. They're pattern recognizers. They read millions of data points per second, calculate probabilities, and make trading calls based on confidence scores. Buy 82%, hold 40%, sell 65%. That precision gives them speed humans could never match. During the COVID-19 crash of 2020, AI models inside BlackRock's Aladdin platform reduced exposure to travel and retail weeks before the market collapsed, saving clients billions. But speed doesn't equal foresight or 100% accuracy. When Elon Musk tweets about Bitcoin, or when a war breaks out overnight, AI doesn't anticipate the chaos, it reacts to it. And by the time it does, so does every other algorithm. That's the paradox. When all AI agents are trained on the same data, reading the same reports, using the same logic, none of them have an edge. It's not artificial intelligence anymore. It's artificial herding. The moment every system spots the same opportunity, the opportunity disappears. Because in markets, what makes you money isn't knowledge, it's asymmetry. And AI erases that by making everyone equally informed, equally fast, and equally predictable. Of course, AI has had its victory. A Goldman Sachs study found that machine learning portfolios outperformed traditional stock pickers by 15% during stable, low volatility markets. And in Japan, AI-driven models at Nomura Securities predicted an economic rebound months before the central bank did. But when the world stops behaving like a dataset, AI starts making mistakes at scale. In 2022, London-based XTX Markets lost millions when its AI trading system misread macroeconomic data after Russia's invasion of Ukraine. The model couldn't comprehend fear. It just recalculated. And in 2023, the Kraft AI-enhanced ETF, AMOM, a fund that proudly marketed itself as AI-managed, underperformed the S&P 500 by nearly 20%. The problem wasn't speed or data, it was understanding. Ray Dalio put it bluntly, "He who lives by the crystal ball will eat shattered glass." AI reads history better than anyone, but markets are written in human behavior. The smartest funds today don't use AI to replace humans. They use it to sharpen them. At Bridgewater Associates, AI models forecast global risks, but human managers decide when to intervene. At Citadel, AI predicts trade entry points, but experienced traders decide when those signals feel too crowded. Because that's something data can't feel: crowd psychology. As George Soros once said, "I'm only rich because I know when I'm wrong." AI doesn't know anything, it just adjusts equations. The human mind can see irony, contradiction, and narrative, things that don't exist in code. That's why the future of investing isn't man versus machine. It's man with machine. AI handles the volume, humans handle the variables. There's one last truth most investors don't talk about. Automation removes cost, but it also removes control. You might know what your portfolio holds, but not why it's holding it. In 2023, an algorithmic trading chain caused nearly $1 trillion in losses within 48 hours. No emotion, no manipulation, just logic gone wrong. The more we delegate to code, the more fragile the system becomes when code misfires. AI doesn't panic, but markets do. AI trading has made investing faster, cheaper, and more rational, but it hasn't made it human-proof. Steve Jobs once said, "It's not the tools you have faith in, it's the people who use them." And that's the truth about automated investing. AI may trade without emotion, but emotion is what makes investors human, and humans are what make markets real. So no, AI isn't replacing investors, it's forcing them to evolve. The smartest investors won't surrender to algorithms, they'll partner with them. Because in the end, AI can analyze, but only humans can understand. If you want to keep understanding the real cost behind the technologies shaping money, the hype, the data, and the truth, hit subscribe and stay tuned. Because on this channel, we don't sell dreams, we explain what they actually cost. Would you trust AI to trade your money? Comment and let us know.